Hello and welcome back to the channel, your go-to source for demystifying complex market mechanics. Today, we're diving deep into the world of hard-to-borrow stocks and potential short squeeze setups. But before we get started, a quick but critical reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Alright, let's talk about LBGJ. This micro-cap company with no specified sector recently landed on our screener due to some truly eye-popping data points. Looking at recent price action, LBGJ has shown absolutely no movement. Today's change was plus 0.0%, the last 5 days were plus 0.0%, and the last 30 days were also plus 0.0%. The volume tells a similar story. Today's volume was 0 shares, the 30-day average volume was 0 shares, resulting in a relative volume of 0x average. This means LBGJ is incredibly liquid right now, with virtually no trading activity. What is cost to borrow and why it matters? So, why are we even talking about LBGJ if it's not trading? Because it's a prime example for understanding what happens when a stock becomes hard to borrow. At the heart of a short squeeze is something called the cost to borrow, or CTB. When you short a stock, you borrow shares from a broker and sell them, hoping to buy them back later at a lower price. But borrowing isn't free. Brokers charge a fee, and this fee is the CTB. It's usually expressed as an annualized percentage. When the CTB skyrockets, it means demand to short a particular stock is extremely high, and the supply of shares available to borrow is very low. A CTB over 100% means it costs you more than the value of the shares just to hold your short position for a year. This is a massive red flag for short sellers, and a potential signal for squeeze watchers. Why this stock is hard to borrow right now. Now let's apply that to LBGJ. This stock appeared on our hard-to-borrow screener with an astonishing annualized cost-to-borrow fee of 1150.2%. That number is not a typo. Over 1100% just to borrow shares for a year. While its CTB momentum is not available, and the exact shares currently available to borrow are unknown, we do know LBGJ has an estimated float of only 3.0 million shares. This tiny float, combined with that incredibly high CTB, strongly suggests that any shares available for shorting are extremely scarce and expensive to hold. This is precisely the kind of setup that can lead to significant pressure on short sellers. Our internal composite squeeze score for LBGJ, which combines factors like CTB level, float size, and other metrics, currently sits at 44.2 out of 100. Squeeze mechanics explained. So, how does a high CTB lead to a short squeeze? Imagine you've shorted LBGJ. You're paying over 1150% annually to hold that position. If the price starts to move up, or if the shares you borrowed become even scarcer, that borrowing cost becomes unbearable. To stop the bleeding, or to simply close your position, you have to buy back the shares you initially sold. This buying action, often forced and sudden, drives the price even higher, forcing other short sellers to cover, creating a cascading effect. This is the essence of a short squeeze. Short sellers are squeezed out of their positions by rising prices and prohibitive borrowing costs, creating a rapid upward movement. For LBGJ, with its tiny float and zero trading volume, even a small amount of forced buying could theoretically have an outsized impact on the share price. The liquidity remains a major concern. Dilution risk check. When evaluating any potential squeeze candidate, it's crucial to check for dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This can add supply to the market, making it easier for short sellers to cover their positions, thereby negating or significantly offsetting any squeeze potential, even if the cost to borrow is sky high. For LBGJ, we performed a thorough check for recent dilutive SEC filings like SMINUS-1, SMINUS-3s, or 424BS in the last 90 days, and found none. We also checked for recent reverse splits, which can artificially increase share price but often come with their own risks, and found no reverse split for LBGJ in our look-back window. This is a positive sign, as it suggests no immediate new supply of shares hitting the market that could undermine a squeeze thesis. As always, it's important to keep perspective in these discussions. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For LBGJ, the situation is unique due to the zero trading volume. While the 1150.2% CTB is undeniably high and the 3.0 million share float is small, the lack of any current trading means there's no price discovery. This can be a double-edged sword. On one hand, any sudden buying interest, even a small amount, could theoretically move the price dramatically due to the extreme liquidity and scarcity of shares. On the other hand, the absence of volume also means it could be incredibly difficult to enter or exit a position, posing a significant liquidity risk. A high cost to borrow doesn't guarantee a squeeze. It can also mean short sellers have extremely strong conviction in their bearish thesis and are willing to pay a premium to stay short. What you'd want to watch for are any sudden increases in trading volume, even small ones, as well as any changes in the shares available to borrow or the CTB rate itself. So, LBGJ presents a fascinating, albeit highly speculative, case study in hard-to-borrow stocks. With a staggering 1150.2% cost to borrow and an estimated float of just 3.0 million shares, it clearly ticks some major boxes for a potential short squeeze candidate. However, the current zero trading volume adds a layer of extreme liquidity to consider. This is a perfect example of why understanding these metrics is crucial, but also why careful research and risk management are paramount. If you found this explanation helpful, please hit that like button, subscribe to the channel for more deep dives into market mechanics, and let us know in the comments if there are other hard-to-borrow stocks you'd like us to analyze next. Thanks for watching, and we'll see you in the next video.